Hello guys, glad to have you on board again today. Sorry for the little delay. I had an appointment earlier today that just pushed all those things later in the usual schedule. I'm gonna do it quick anyway because it's pretty late and I still got to eat right after this one, so probably a half an hour long at best in today's podcast. Even though there's still a lot of things to talk about regarding mostly like talking about the bitcoins and cryptocurrencies in general. A lot to say about them since the last time we talked. Obviously, a lot to say about Wall Street, all the riskier assets. We've got to talk about Tesla as well. That's a funny thing, but still, we've got to talk about this one. I'm not going to avoid the problems. I'm going to have to talk about the yen. Still is my favorable scenario over the course of this week and eventually next week. Still looking at the gold accumulation, of course, because all of these are, sorry about that, are intermediate level midterm scenarios, like either bullish ranges or bearish ranges here and there, accumulations. These are the things you must be into or looking into if you are an intermediate level trader. So let's get things started. Cryptocurrencies first. Let's assume that, all right, let's make it quick. Let's try to do what we've done yesterday with the God damn it, with the MCQ test way of analyzing a market. So in here we're typically having something really interesting happening in real time. Right, you've got your price, okay, you've got your momentum sine wave and taking profit structure, might be on the verge to show up. Remember that this one is definitely not closed, so you shouldn't nearly consider that as valid until it has closed. All right, if it closes as well, we can add a divergence to it as we're making new lows, but certainly not on the momentum. So yeah, there is interesting patterns in here. And now let's have a look at where we are. We are trading with a 61% Fibonacci retracement. All right, we're inside the context, so that should ring some bells, don't you think? This is a typical bullish range context, so it's still pretty much speculative, which means we're far from reversing in here, so we definitely need to have a blue triangle in here, suggesting the prices are bullishly reactivating in this area. So far, we've got none of this, so it's a spending signal, which waits for, first of all, the momentum confirmation, and afterwards, price confirmation. So it's still something that may happen in a few days, certainly not right now. What that means instead is that if you want to be a little bit more aggressive, like let's just split the community into people, right? Intermediate level is just like a mix-up for everyone. So if you're most likely among the beginners, like a white or a green people, please don't go down this road. If you're more like a yellow people or eventually an orange watching at the intermediate level just to consolidate the knowledge, then I think you're fine doing those things and you probably already have done it. So if you highlighted this potential context, then just go lower time frame and try to find a suitable scenario to forecast. Oh, god damn it, I can't stress that enough. I never thought it would happen. So we still need 2 hours to confirm this one as well, right? But for more experienced traders, you've got your triangle below context plus momentum sine wave and taking profit. The context a lot has been dealt with. We figured out that the context is favorable, but we had to check. All right, so this is a pending signal, so you can certainly not take the trade right now, but if the candle closes like that, I think there is a bullish signal to take care of. All right, the type of bullish signals that definitely follows the plan. All right, the global context we're dealing with in here, all right, is that we need to scroll back in time, all right, to figure out what that context is. So what is that? We are dealing below support context, all right. Where do we come from? From the resistance context. It's been a hell of a long shot in here. Afterwards, we were coming from the support context. Prior to that, we were coming from the support context, coming itself from the resistance context. All right. So the overall scheme, the overall price scheme is this one. All right. We're dealing with that. It's a bearish range consolidation. Even though in here it's been triggering a neutral range signal, right? We've now broken the previous lows. which means we're just extending to new lows. So what we deal with in those contexts is that we try to buy below the context, certainly not inside, right? The reason why the last time the buying entries were possible was in here. This is where I got in personally with very tiny amount of capital, just as a late trade, all right? Like I thought, right, maybe we could hold on to these areas, though I decided to get slightly in. Didn't work out, all right? But now we're into the interesting speculative area. This is totally different. What I've done in here is a very tiny portion of buy and hold, but it was a buy and hold, definitely not a speculative trade. But here is speculative trade possible. We just need confirmations, and moreover, it's just a freaking taking profit. So taking profit definitely isn't the best risk management system, all right? But we're into the tradable area if that signal is validated in 2 hours, which is still not the case, okay? So cryptocurrencies, wait for this, only for experienced traders, definitely not beginners, because you know how to deal with it. You know that the taking profit structure is definitely not the best case in here to risk manage, so you're really going to go with a tiny position sizing, large stop loss because of the volatility and stuff like that. But I think a buying entry can be somehow made out of this area. Speculative trade, definitely not buy and hold. Remember that buy and hold area is far lower prices. I don't buy and hold until we get below 6,005K right now, but that doesn't prevent me from taking a speculative trade on top of this if I see an opportunity. I see an interesting area, I'm waiting for the opportunity to trigger or not. Stock market, or Tesla first. All right, though Tesla is profitable. How can you even imagine that? That's great. So we go for a further consolidation. Sorry about that. So first wave, now we get the second wave with a huge 20% up gap straight up to $300. So yeah, Tesla's been profitable. Oh, great is that. So I don't know, I don't really know what that means. I don't know if it's sustainable or if it's just a somehow accounting manipulation or whatever, but anyway, I'm gonna go for the bright side a little once in a while, and I'm gonna go for, all right, this is just a 2 sets of wave consolidation reaching out to a very interesting area, but still I'm gonna have to take some losses because this is where my previous entry was, even though I had a pretty fucking good price. Oh damn it, I mean, I probably have been stopped out of Tesla. Oh, let me check that. Oh my goodness, at some point I can be lucky, even though Wall Street hasn't been really nice with me recently. At least in here I'm pretty fine. I'm just off this fucking 20% gap, so that's great. I actually somehow managed to put myself at break-even back in those days, which means, yeah, I had such a good price that I put myself at break-even. If my memory's right, I had Tesla right in here, and I just got stopped out like a few days ago. I didn't even notice it actually, but oh man, thank you for that, because you stopped me in here. I'm avoiding the 20% loss today, not 20% capital loss. All right, I was definitely not leveraged in here, but still I'm happy. I'm not gonna take and suffer this gap. Am I going to sell? I would say yeah, eventually, but not necessarily at the open, so I'm going to wait for further information. But yeah, eventually selling again might be interesting, like somehow have a deeper pullback to this area, which is interesting. Like this is the trendline pullback. I think selling in here is making quite some sense. So I'll look forward to it. The Tesla is going to be to watch out for within the next few days. But obviously, if you had it on the portfolio without stop losses and that you're going to take a 20% gap today, sorry, you're going to have to take the loss anyway, all right? Certainly don't hold these kind of assets as they run up, all right? Finally being profitable for Tesla is a huge deal. Is it going to mean pricing that in for a bullish trend market just right now? I sincerely doubt that, but that's still a good news and certainly not something the market was expecting. But I had to talk about it. The rest of the stock market. Yesterday, I told you I triggered a trade, intraday, 15-minute trade. Maybe I've been too aggressive. I should nearly have gone their way. I had no momentum. I was totally aware of it. I might have gone a little bit too aggressive. My goal was to get in here, secure the fucking trade. We never reached out to the support context, which means I had to suffer this upward move by the earnings release. All right, like the market somehow surged by the end of the U.S. session. It was totally unexpected, but that's how it goes. I mean, you never control the market. So I was pretty much surprised. Although this is risk managing, right? I got my stop loss like in here. So far, I'm still in, but the market sincerely wants my stop losses. I can't stress that enough. They really made it clear. Bears can't hold up in these areas. Bulls are in control. Though if I have to take that stop loss, I'll take it. All right, it's just a 0.5% stop loss, not a big deal. Maybe I've been too aggressive. And I probably have been. So we'll see about that. Anyway, I'm still waiting for a global scenario in here. Just trying to profit from this fucking range area we've got in the 1 hour. So, you know, I think in here, what we're dealing with is just the market trying to break out of anyhow range areas. So trying to break those range targets is very less likely going to trigger trends. It's most likely going to trigger traps. But I see so many people ready to fall right into them just because there is no alternative. We have to get to stock market because there's so much money circulating and no one selling that any dollar created must go into the stock market. Certainly not into the real economy, all right? Like the QEs and stuff, they certainly not ripple through real credit. They just stay into financial institutions. They use it as collaterals damage to buy new stocks and avoid selling the old ones. So it's just rising prices. I can explain that in a single sentence. It's actually the rule that has been pulled out the day the market bottomed up in 2009. I might found this rule again I should get the name. All right, I'll get deeper into details, but if you want to dig it out on Google, you'll easily find it. It's a rule that basically has been triggering 2008 crash for a simple reason. It was basically saying that if you're a bank and if you have lots of assets in your accounts, the value of those assets is determined by the last traded value. All right, which means if the value is surging to the downside, then if you have, like, say, for example, 2,000 shares of Apple, if Apple is crashing down, like people are selling in panic, then those 200,000 shares you've got worth what they worth at the market price. All right, now is no longer the case. Now you can assess the liquidity of a bank by the price of the assets when they sell them, which means Apple worth what they think it's worth as long as they haven't been selling them. That's the magic beauty in which we live in right now, which means asset prices are really great when they go up. They don't matter when they go down. So when prices go down, those who hold the large amounts of those shares are not forced to sell them because they define their own value for them. That's great. All right? That's a future we live in a beautiful future in which those who hold assets define the asset prices. So that's definitely not a market, all right? So this rule has been set in motion back in those days to prevent market from risk-taking in irrational manners, and obviously that's been creating the 2008 crash, not causing, but being part of the problems that rippled the systemic issues in 2008. So obviously we don't want that to happen again, so we destroy that rule, even though that rule is absolutely necessary. Do you really think that that the world should work out this way? I mean, let's just give you a quick example of what would it look like into an equivalent into the real life. Like, for example, I don't know, what can we do to use that? Yeah, that would be the tulip bubble. Actually, that would be the best case example. Like, we're not dealing anything, all right? Like, nothing is exchanged. Like, I put a price on something, and either you buy it or you don't buy it. All right? It's simple as that. I tell you that these are the market price for these things. All right? I put the prices higher and higher day after day. Because anyway, these things are so bullish that you can't resist buying them. Because at some point, this is exactly what happened with the tulip bubble back in those days. people got into buying those things that were absolutely illiquid, which means the price meant nothing but what you were expecting them to be the next day. And that's exactly what we're getting right now into. Like, we've been surging asset prices so high that people tend to believe they'll never go down. Because anyway, if it goes down, central bankers will save us or whatever. That's the new fucking paradigm we're in right now. Asset prices have no price because we price them the way we want. And if they start to go down, we simply don't sell. All right? But that's the thing. That we're printing prices, all right, for you to buy those things that worth actually, we don't know how much they're worth, but all we know is that as long as you buy them, you give us money. All right? That's how the banking system works right now. When you buy stock, you're lending money to me. I'm buying the share and I give you the share. All right? So you at least own part of a company. That's better than owning a tulip. I mean, I compared to it, but it's certainly not the same case. All right? When you own a part of a company, you own much better than just a fucking tulip. All right? But this is exactly the problem right now. Do you really think those share prices, those portions of companies worth that much? We don't know how much they're worth. Like, do you really think Apple worth $1 trillion? I doubt it. I sincerely doubt it. But that's what it costs right now because people feel like it must only go up, just like the tulips prices were about to go just up. Do you really needed a tulip back in those days? Certainly not, but you were buying them hoping for someone else to buy them higher priced the day after. That's exactly what we're dealing with right now with apples and stuff like that. Profitability has probably reached the market top, but we don't nearly give a shit about profitability anymore. It's just people will buy that shit with more expensive prices tomorrow, and the valuations will most likely increase. So why the hell would I sell that? No one's selling. People, a very few people, stupid people are buying with high level of risk taking that they don't nearly know about. And we're living in that beautiful world because no one has to sell, because if the market starts to go down, we simply don't sell. And if there is no sellers, we just need a few share buybacks and stuff like that, and we magically put the market prices higher again. That's exactly what has happened with Apple. They've been losing 40% valuations. Do you really think that the guys who were holding this in their account were negative as hell? Yeah, there were, but they just said, all right, we don't sell. Because anyway, we can't sell. If we sell, we're bankrupt. So we just don't sell. That's the beautiful world we live in. Anyway, I'm not going down this road. Like I told you, buying is out of context right now, way too dangerous, at least for the next couple of, let's say for the next 2 quarters. If we're still there 2 quarters from now, then I think it's about time to really stop selling. But, I mean, so many things can happen in 2 months, in 2 quarters. Anyway, what we're dealing with right now is that asset pricings and some specific asset, and I'm really targeting Apples and stuff like that, and Apples and Microsoft, like the 2 biggest market caps in the US stock market. These 2 are really fucking bubbles to me, and this is really dangerous pricings, but it feels like, just like in the tulip bubble, people don't really care. So believe me, they'll care about it sooner or later because I know the reality, and it always catches up on dreams. But anyway, dreaming is about the current motive. So I can't fight the dream. So like I said, I mean, if I get to be stopped out with Microsoft, I'll do. I don't think I don't think I will. So for now, I'm still in. Apple, I just can't risk manage, which means if it goes too far, I'm going to have to stop my speculative trades. The one I took a couple days ago. It might also signal the end of my trades on DAX, SPX, and Nikkei I just took yesterday, simply because I've been too aggressive. But like I said, yes, I might be losing 0.5% a little once in a while because they take my stop losses. Don't worry. The day I'll get in, I'm going to take a little bit more than that. I'm not going to be billionaire, like I said. I'm not going to turn myself a billionaire if it goes down. Just saying, if it goes down, I'll let it go. I'll let those trades over weekly cycles. All right, like this is definitely what I'm dealing with right now. I'm waiting for this weekly cycle to trigger itself. Like, have a look at this sine wave. All right, let me just delete the original sine wave so you'll see much more clearly what this is about. All right, so these are our weekly cycles that you have in the background. All right, what are called the trend cycles. So right now we're in a bearish trend cycle. But do you see prices going bearish? No, we don't, because, all right. But the problem is normally in the bearish cycle, resistance are holding, supports are melting. And the difference is right now we're having quite the opposite. Like it feels like, oh, no, bearish cycle, that's not possible. We can't break out supports because no one will sell a support, all right? People will sell below the supports if we ever go down there, but we can't go there because when we go down supportive areas, short-term traders are speculative on buying, and I can understand that. Like I said, if you have short-term visions of the market, buying the support areas is still a good choice. I mean, as long as they hold on, you're fine to do this. So when we get to a support area, no one sells because, I mean, why would they sell? They're not forced to. They can be literally bankrupt on a day-to-day basis, meaning that they don't have enough value stored in the assets to justify the deposits. So the banking system will be on failure. But when it is, no problem, we just don't sell the assets. We wait for the short-term speculators to save our assets. We wait for Trump to tweet, and we wait for the Fed to rate cut. So we can do anything but buying more stocks. So why would we sell if people will buy more stocks? Like I told you, it's a real dangerous problem, because when we do this, we don't price stocks. We're just hoping that everything will do fine and that the beautiful system in which we believe is going to sustain, which means we go to lower rates, we go to higher asset prices, and anyway, more monetary injections to support the problems it creates with the lending markets. Like the debt market is in pure crisis right now because we really face a reverse yield curve, so something's really wrong. But I mean, monetary injection is the solution to every problem. Like some banks are not solvable or they bankrupt on a day-to-day basis, so let's just lend them money on a day-to-day basis so they can just move on to the next day. That's exactly what we're dealing with right now. Banks do not longer lend to each other at the targeted repo pricing, which means the Fed's 1.75 to 2% rate. So the problem is banks think the rates are too low regarding the risks. All right, that's why they were lending them. They were lending their money to higher rates than the targeted rates the Federal Reserve is giving us. So that's why the Federal Reserve is lending the money as its own rate, which is cheaper. Though the central bank is taking the risk that the bank traders see. So banking system sees a huge risk, or at least a risk that is not well priced in. And the Fed just says, all right, we're going to take the risk. Yes, that's fine, but anyway, that signals a problem. So the beautiful bullish stock market, whatever thing they want to call it, isn't yet there. Simply, we're hoping for it to become true. And we're ready to take risks to get there. But we take the risks, the central bank, we take the profits, the central banks takes the risks. That's the problem, all right? I don't think these kinds of scenarios can last really long. And they've been lasting for almost 2 years now, so we'll see how long this can last further in time. And like I said, if this hasn't been triggering issues within the next 6 months, I think we can consider the problems under control. But until then, I think this under control theory is more a great danger rather than the new paradigm we should dive in and believe eyes closed that no matter what, buying stocks is safe. I think it isn't, and I think there is a huge problems of bank solvability if we ever have to someday question what they have in their accounts and how much it actually worth. Because that's the big problem. Like I said, it works just fine as long as people don't ask for the money. When people will ask for the deposits, we certainly know that they can't provide it. So that's the huge deal we're dealing right now. People are asking for the money, the banking system doesn't have enough of it. So what they do is that they have to lend money. And they can't lend to each other at the specific targeted rate because they think the problems with what they have in account worth more than that 1.75% interest rate, so they're lending at higher pricings, and that's the problem. The bank, more than anyone else in the system, knows what they have in their account. We don't, all right? Most of what they have has no real value because it's illiquid areas. Like they have lots of houses into bubblish areas. They have no one to buy them. But they're just fixing the price. That's the beautiful world we live in. The bank says, all right, I think this thing worth that much $1,000. And as long as I think that is the case, then that's it. Though my account, when I make, when I publish my earnings report each and every quarter, all right, this asset is just a line, and what the price which is in that line is the price I defined. So that's great, all right. So you think I'm bankrupt? No, I'm not. I'm just gonna have to move these asset prices to the upside, this one to the upside, and I'm fine. That's the world we live in. I think the banking system is just trying to survive with some old problems, still very active, but all right, we just make everything we can to let them survive as long as we can until they can't, because that's how it is. I think the old dinosaurs of banks we have, very less likely going to survive another decade. Anyway, yen is also the current movement. Sorry, I just lost myself. I shouldn't be dealing with those shit again. So we're looking at the yen index in here. Still has given us a pretty interesting accumulation context in here. I still tend to believe that these assets in here have multiple options. All right, like it's option number one, we have done, sorry, I'm going to use those arrows. We have done this, like it's an ABC structure, and we're overlapping, even though the overlap is not perfect, all right? And we're ready to go for a wave 5 extended. Or option number two, haven't I talked about that already? I'm not certain. Anyway, if I already done it, I'm going to be doing twice. Option number two, this is wave 1, and we're still currently dealing with wave 3 extended wave, which I doubt. I sincerely think that anyway, what we've done in here is more like a wave 5 extended structure along the way, with a much bigger target, like probably a weekly asset price target to come forward, like getting into these areas, resistance, weekly context. I think this is where we're going. All right, so if yen goes up, gold goes up, how can the stocks go up? But the thing is that right now we do everything we can to prevent the gold and yen from going upward. So yesterday was an attempt, today is obviously invalidation of it. That's the reason why I called the stocks. I sold the stocks yesterday. I thought we had a timing with gold. Unfortunately, it looks like they don't want that to happen right now. So I'm going to wait. If I have to be stopped, I will trigger those stop losses and wait for further appropriate timing to do so. Once again, I haven't been selling without clues. I've been selling respecting the strategy. I do have my daily signals, whatever. It's just, all right, the market doesn't want to. I can understand that for many reasons. It's the motive we were in all year long, like not going down. We're going up because we must not go down, but I still tend to believe we will, and probably will before the end of that year, which leaves us with a couple months in which I don't know what, but I think something ugly will happen, lead us to this area pretty rapidly. Another buy and hold, I think, another V-sharp reversal down the corner, but I think we can hardly spend the entire year in here with the current economical context. I think we have to suffer another volatility era. All right, so I'm still waiting for it. We're in this fucking weekly bearish cycle, but so far prices doesn't want to go down. But I think anyhow, when they will, we're very likely going to have a bearish momentum with potentially bearish prices. In order to do so, momentum has to break this trend line in here, and the prices have to break this one as well. As long as they don't, all right, we dry out in here. In the meantime, so we have two interesting areas, a short-term area in here. Obviously, bulls will do anything they can to try holding this area to have a peaceful end of the year. Problem is, if it doesn't work out, and if we go break this area, it's a straight line in here, and I better hope we do this before December, because closing the year in here is less likely. I think we shouldn't be closing the year in here, most likely closing at the average, like closing it approximately into those prices. I think 27.50 is a pretty decent close for this year. Anyway, that being said, watch out for gold accumulation. Watch out for yen accumulation as well on a daily basis for this one. On an H1 time frame for this one. Look out for what type of trades do we have in ranges right now? Look out for ranges. SPX has been providing us the range trade over the course of the night. It was 15-minute time. So I just got a little bit too aggressive in here, trading without a momentum signal. So I knew it was risky. I just thought I'd be able to risk manage my trade. When we got close to it, we just barely got to the risk management area, just didn't go there. That's part of the life. I mean, I know Wall Street likes to grow out of sellers' pain. So, all right, I don't like the way they do it. I don't think it's really fair, but I mean, the market is not meant to be fair anyway. So that's the game. That's how it is. If they take my stop loss, then that's just a stop loss, and that's going to stop me. Anyway, see you guys tomorrow for the experienced ones. As intermediate traders, still trade carefully right now. I still believe USD/JPY is the most interesting thing to watch out for right now, as it doubles down on my dollar and yen scenarios, in which I tend to believe that the dollar in here is having a little bit more downside to deal with. Looking for a termination structure, just dipping slightly lower to what we're doing right now. I don't think we can go crazy lower. All right, we've got a range target in here, which means we're very likely going to oscillate, which was the plan, before going any further in time. All right. Let me think about it. If I just forgot anything, I don't think I did. All right. All right. And euro dollar, still the same problem, all right? We're going to do the same opposite thing, like dying in here, drying to just spend like the 30 bars. We have to wait for this breakout to digest before going for higher valuation. So, yeah, I would say wait for early December to get the euro dollar to trend again. In the meantime, just manage the risk. I personally don't see that much risk in here, so partial profit taking, and that's it. Same thing for GBP. Then going in there, we're going to have to go sideways until, bam, we go again. So I think there's no more gains to make in here in the short term, most likely waiting for better gains and further gains to come forward. But right afterwards, same timing in here. I think December, late November is going to be the timing to go surge again on those assets. So dollar sideways. I think yen going bullish is the next timing, because I don't think this one can last until late November. That could be an option. All right, like I said, if somehow Wall Street wants to go crazy bullish, they can. They will just try to hold the yen as low as possible for as long as possible. They will do the same with gold, like maintaining them under pressure to avoid any riskier assets to be sold. Otherwise, yeah, yen starts to trigger the trend. VIX builds another support, and that can't be bullish for all those guys. All right. So I don't know what the future is. All I can tell is that we're dealing with short-term trades in here, time frames that I don't trade any different than a little pick, a little once in a while, out of volatility trades only, and that's probably what I should have done yesterday. All right, I should have waited for volatility boundaries that we've reached out to, not yet. All right, so as you can see, 15-minute trade. I shouldn't have taken this one because we were not dealing with volatility boundaries. So the only thing that works right now is volatility. That's really dangerous once again, because we should see that volatility in both directions. But we see it only to the bull side, which is really, really dangerous, because it only says one thing to me. We're piling up the risk out of our revision, and I tend to believe this risk will show up in a compacted manner. Like, we're going to have to price all that shit in at the same time, which means probably a lot of bearish volatility. The one I just told you about earlier, like, I still tend to believe that the next weekly cycle is very likely going to head us down to this area. All right, with an intermediate in here to validate. Like, we go there, we validate, and bam, then we go straight to this area. And as you can see, it would just be a lower volatility boundary. So very interesting buying entries for those who actually want to buy stocks at any cost. And I can understand that. Like I said, in here I'm ready to buy. I'm not going to buy stocks. I'm just going to buy myself out partially. I'm going to profit take in this area. But certainly buying in there, all right? Like I said, profit taking a bearish trade is like buying. So I think yes, I think the buying area for Wall Street is in here. This is where people should buy, but now they are buying short term because they think we're going to go there first. Right? They think we're going to go there before going in there. Like I said, it's a bet, but it's a dangerous bet because in order to get there, all right, you know that you're also risking to lose that, or eventually even take a nasty loss in between. Right? So short-term calls, I can understand that very well. The problem is, at some point, we're avoiding some risks, and that's not a good sign. I'm just waiting for this to eventually trigger or not, all right? Like, but for now, we haven't been breaking bullish in the weekly schedule, and if we do, I mean, that will be a game changer. Like, if we were about to break out this this bearish cycle, like creating a bullish breakout on the weekly time frame, I would be really, really, really concerned about it because we've got absolutely nothing to actually support weekly breakouts. I mean, remember that weekly is dealing with economics and macroeconomics projections. We can't break out as we haven't been pricing any risks in. We've been hoping for the best. For now, it's not the worst case scenario, so there's no need to crash down, but there's certainly no need to break any resistance. All right. That being said, I'm going to leave you guys with that. Have a good day. See you tomorrow. Trade safe and don't take too much risk. All right. I might have been taking a little bit too much risk yesterday, and the sanction might be just coming along the corner right today.